How you guys doing? My name is Jovan Salamita, and I'll be presenting on time value of money from chapter 5 and also on risk and rates of return from chapter 8. I have entitled it Financial Asset Allocation and Investment Tax Strategies. So we begin with chapter 5, where it talks about the importance of saving for retirement. And the book asks, will you have enough for retirement? And if you look at the average Americans, they only save 5% of their income. And there's a steady decline in the ratio between workers and retirees. Back in the 1950s, there were more workers than there were retirees. It was actually 8-to-1 ratio. Now, in the 2010s, it steadily declined to 3-to-1. That's because the generation of the baby boomers every single year is retiring. Millions upon millions of Americans are retiring. And now America has a cash flow problem. I mean, they've always had cash flow problems, but now it's imperative more than ever because this generation of people are taking more money from the Social Security pool than there is more money going in. Now, how does this relate to the time value of money? Now, out of all the financial concepts, the time value of money is the single most important concept, arguably, because a dollar in hand today is worth more than a dollar to be received in the future. And because you can invest in it, you can earn interest on it. It's because of the process of future values to present values. And it's due to the compounded interest concept. Now, in other words, compounding interest is interest upon interest. The beginning balance is higher each successive year. Its interest earned each year is increasing at the compounding interest concept. Now, the importance of it is they go together. That's why I had to talk about the time value of money and the rates of return because of the concept of compounding interest. Now, I would have to look at financial concepts with the lens of biblical financial stewardship. And if you look at Matthew chapter 25, verses 14 to 30, the parable of the talents, Jesus talks about being a faithful steward with time, talents, and treasures. So he's specifically talking about a manager going and giving a certain amount of his property or ownership of investment, and he's expecting these managers to do something with it, to be a faithful steward with what God has given us. And so if you look at verse 25, a servant who was given one, and his reason why he didn't do anything with what God has given him, he says, so I was afraid and I went and hid your talent in the ground, and he was judged for that. And in verse 30 it says, and cast the worthless servant into the outer darkness, in place there will be weeping and gnashing of teeth. And so that's a pretty harsh judgment, and we're not going to get into it, but really that's a judgment upon Christians and how they're not faithful with their time, talent, and treasures. Now, if we're going to try to compel people, someone like me who has 4 kids in their 30s, trying to save for retirement, versus saving money for my kids' college fund. Because saving for retirement is not always a priority, because the timeline of college is more urgent and it's seemingly not more important. But the book argues in chapter 5 that it's more important to save for retirement because all you're doing is putting from one pocket to another, from future values to present value. And it doesn't cover it in the text, but I was just thinking about it. College, you can get a scholarship. You can go to West Point and get a full ride, go to Moody, get a full ride, but you can't get a scholarship for retirement. You're literally just trying to pay yourself in the future. So if trying to compel people to save money for retirement and save more than 5%, if we're going off of Malachi chapter 3, verse 10, and saving, giving the first fruits and storing into the storehouses and saving a tithe, we want to take a practical approach and feel confident about why and where your money is placed. And we're going to look at financial vehicles and briefly compare them, and we're going to look at the rates of returns and what can we expect to receive from these financial vehicles and how the government treats these financial vehicles. And so if you look at what people have access to, they have access to local banks. So what kind of rate of return can we get from a financial vehicle as in savings accounts or certificate of deposit, CDs? Are they advertising what their rates of returns on their windows, on their billboards? No, you won't, because the rates for CDs is really low. I mean, if I were to say the rate of return on a CD is 2%, that would be like pie in the sky. We haven't seen anything like that in years. Now, according to our text, historically, the rates of return on banks has been declining because historically it was at 15 to 20%. Now, if you look at bankrate.com, it shows real-time savings and CD rates. Now, if you look, you'll find that it's less than 1%, not annual percentage yield, not the APY. So, inflation is the new it is the standard of how we should judge of where our money should be placed for a vehicle for retirement, because that's what we have to defeat. Historically, on average, inflation is about 2 to 3%. That is our standard, and we have to defeat inflation. So, okay, let's do a little bit of math. If historically inflation is at 2%, but if we put our money into a bank that at a CD at 1%, what just happened to our money? If our money in the bank is going at a rate of 1%, but we have inflation bringing it down at a rate of 2%, what just happened to our money? The 2% inflation is hindering the rate of return. And not only that, once you withdraw the money out, the government's going to say, hey, yeah, some gains on that. We're going to tax you on an average of, depending on your income, we're going to tax you at a 25 to 28% tax. So with a bank, when you put money into the bank, one, you're not even breaking even, and two, you're losing money. So now we're going to look at other vehicles like stocks, bonds, and mutual funds. But if you put your money into a bank, you not only lose money, but you're guaranteeing you're going to lose money because you're not defeating inflation. That's putting your money in the ground where you're going to get judged, and you're not being a biblical financial steward of your money. Now, if we look at stocks is, I used to think that stocks was owned by executives or something that you couldn't obtain. But according to our text, stocks is really just ownership. You're owning a share of the company. Historically, it was like merchants selling livestock, and so you would own a portion of those livestock, and whatever it produced, you would earn interest on the production of that livestock. So in modern day, owning a stock is owning part of the company. So, but it has more risk. So, more risk, more reward. So, generally over a moderately long period of time, the rate of return on stocks is 10 to 12%. Now, investing into the market at 10 to 12%, and it looks attractive, but I know everyone's heard horror stories of people losing all of their money in the market. But if you look at it this way, you have to ask yourself, how long you're going to be investing into the market. And the magic number is 12. So if you're having a discussion with your friends and about what are you going to do as far as what are you going to invest into the market, how long are you going to market, the question really is, what are you going to invest into and how long you're going to be investing. And the magic number is 12. And I would argue, if you would analyze the market over the past consecutive 12 years, the market has always beaten inflation, always, or outperformed inflation. World War I, World War II, 9/11, the mortgage collapse, this current recession right now has always outperformed inflation. Because that's our new benchmark, that's our new litmus test, that's our new watermark. We have to beat inflation. So with that being said, it's urgent. It's more important that we put some money into the market and not put it into the bank. That's not where we should put in our monies into. So now, if you put money into the stock, it is no longer treated as ordinary income. It's treated as capital gains and capital gains tax, because the government is saying, "Hey, good job. We want you to put money back into the government, into society." By definition, a capital gain is a profit that results from a sale of a capital asset, such as a stock, bond, or real estate, where the sale price exceeds the purchase price. And a capital gains tax is tax on a profit realized on the sale of a non-inventory asset like stocks, bonds, real estate, and property. Now, in other words, why does the government only taxes 15% capital gains tax, because the government is giving us an incentive to invest into the market. They don't want people to be dependent on the state upon retirement, because they look at Social Security. At some point, right now there is actually not enough money to pay out for the other generations coming behind the baby boomers. Okay, so those are stocks. Now, if we look at bonds. Now, bonds is basically a loan. It's not ownership. Now, for example, like General Motors. General Motors is recently, I don't know, back about a few years ago, they were in the press for some because poor management, and the government's bailing them out, and people were selling off their stock. And so GM had to issue some bonds. And a bond is really just a loan. It's just to offset their losses of people selling off their stock, they issued some bonds. Now, bonds, because of a coupon rate of return, by definition, it's the rate of interest it pays annually. So a coupon rate of return is just a glimpse of the performance of a bond. So, for example, in our example, at the end of the 5 year, if you were to tell GM, hey, all right, I don't want to buy a stock, I want to buy a bond. What you're doing is that I'm going to give you $10,000 GM, and at the end of 5 years, I want my entire principal back plus interest. That's what pretty much a bond is. So it's safer. You're almost guaranteeing the money back with interest. It's so less risk, less reward. So the rate of return on a bond is 4 to 6% over the long period. Now, the next financial vehicle that we're going to look at is mutual funds, or ETF, exchange traded funds. By definition, an ETF is an asset such as stocks, commodities, bonds, and same thing with the mutual fund. It's a portfolio constructed and maintained to match the investment. The difference is a mutual fund has a financial objective based on the prospectus, depending on the mixture of stocks and bonds that are in their portfolio. So in other words, imagine a bucket, and this bucket contains a mixture of stocks and bonds. Depending on your level of tolerance of risk, the rate of return is based on majority of how many stocks you have or bonds. So if you have more stocks in that bucket of mutual fund, it'll be more volatile. So the rate of return is like a roller coaster, and it's a higher rate of return, but it's really volatile, it'll go up and down. But if you have the majority in that mutual fund as mostly bonds, it's a little more stable, it's more predictable, it's more reliable, because they're bonds. So if we're going to look at all of these investment vehicles and what's the most appropriate and moderate to long-term investment, stocks, bonds, and mutual funds, I would say the mutual funds, because one, out of all of them, it has the most user-friendly type of asset class. And so if we look at mutual funds, it's not like stocks or bonds where you're actually putting all your eggs in one basket, right? You are diversifying if you put your money into a mutual fund. If you put all your eggs in one basket, it's kind of like the story of Enron. When Enron collapsed, before it collapsed, actually, it was a top stock pick 3 consecutive quarters. And if I was a day trader and giving advice to people to where to invest, Enron was a top stock pick. But if you put all your money into that stock, you would have lost all your money. But for example, if you had a mutual fund and you called it a large company energy sector, think of as a window panel, right? Just a window, one piece of glass. If somebody were to throw a baseball through it, it would shatter the whole entire glass, and you would shatter all of it. You would lose your investment. But if you had a window panel that has different types of bracing on it, I'm going to draw a picture, and it kind of looks like this. You have different stocks and bonds in each of the panels, and if Enron were to collapse, it would just collapse that window panel, but all of these other window panels are still intact. It offsets your loss. So it's not necessarily putting all your eggs in one basket. If the goal for retirement, if the goal is retirement, it would be mutual fund. And if you want to keep it more conservative, it would be investment into the bonds. But if you love certain companies like Samsung, Apple, Google, Facebook, and whatever, then buy those certain stocks, but keep that separate from your retirement nest egg. And because you want to find a vehicle that takes advantage of the time value of money and the rates of return. Okay, so if you look at the next slide, the retirement nest egg, if you look at it as an incubator, as long as you don't touch it until 59 and a half years old, and that's an IRS rule, the government is going to give us 3 provisions on how to grow our money. It gives us the first one we're going to talk about is tax deduction. Now, tax deduction is no taxes on deposit. Now, to further explain it, if you look at the slide, it says gross income tax bar graph right there. It says 25 to 28% tax. The purpose of taxes, I get it. So taxes in governments, we have to have a standing army, we have to have interstate highways, etc. I get it. But the government is going to give us a deduction because we engage in certain behaviors that's beneficial to society, like getting married, having kids, buying a house, giving to charity, starting a business, or putting money away for retirement. Now, if you put money for retirement, the government's going to tax us on the gross. But if we tell the government, hey, I did this, and this, we're like, oops, sorry, we unfairly taxed you. So we're going to adjust our tax on you. We unfairly tax you, and this is the adjusted gross income. And then the remainder, the refund, that's our deduction. So in that sense, if you put money into retirement, you put money into an investment vehicle, the money is allowed to pass into retirement with no taxes on deposit. It goes into the account whole with no hindrance. So the next provision is tax deferral. Now, tax deferral is no taxes on growth. Now, I won't stay too long on this. It's pretty much when you put money into that investment vehicle, it's growing, but there are no taxes on growth. So just to review, no taxes on deposit, no taxes on growth. The last tax provision is no taxes upon withdrawal. That's tax-free income. Now, the most efficient way to put your money is a 2-step process, because there isn't one vehicle that will take advantage of all 3 tax provisions. And because the prevailing advice would be to put your money into that investment vehicle, but the government made up the rules so they won't allow that. So the most efficient way to grab all 3 is a 2-step process, which is because you really can't take all 3. So what you do, you have to have a pre-tax plan and an after-tax plan. So pre-tax plans, you can see that pre-tax plans are 401ks, 403bs, IRAs. If you're a nurse and work in a hospital, it's a 457 plan. If you work for the government, there's pension plans and things like that. And after-tax, most popular after-tax plans are Roth IRAs, CVLIs, IULs. Those are after-tax plans. So the most efficient way to take advantage of those processes is by taking steps 1 and 2 for pre-tax, and after-tax plan, you take 2 and 3. By those 2 steps alone, you take advantage of all 3 tax provisions. So to summarize, if we were taking 10% of our savings and we put it into mutual funds and we take the 2-step process, we cover all 3 tax provisions in 2 steps. And to summarize, what you're doing is you are wanting to be taxed on the seed versus the harvest. Because would you rather have the government tax you on the seed or the growth of the harvest after the seed has grown? Of course, you want the government to tax you on the seed. So now, to illustrate that, we're looking at the slide. So if we take a household dual income $5,000 per year for retirement over 40 years, $200,000 is the principal. So the return on investment over a 40-year time frame is it's about 6.5%. So Hewitt and Associates, according to them, the average rate of return on a 401k is actually 6.5% over 40 years. Okay, so just follow me. The average 401k, a return on investment over 40 years, if a family is investing $5,000 per year over 40 years, they will gain 200,000. And off that 200,000, they've been gaining over all those years, they're gaining about 6.5%. So at the end of that year, at the end of those 40 years, they've gained $1 million. Okay, and $1 million after they have withdrew it, and if after they've retired, they have to withdraw it in one lump sum of $1 million. Now, what happens now is if you withdraw $1 million, the government's not going to look at it as capital gains. They're going to look at it as income. And then what tax bracket would you be in now if you have gained $1 million in 1 year? You're going to be in the highest tax bracket. And currently, right now, the current tax bracket, the highest tax bracket is about 39.5%. Historically, it's been like 70% sometime in the 80s. But let's look at the average tax bracket. The highest average tax bracket is about 60%. So if we expose that $1 million at the highest tax bracket, and 60% of that, the government's going to take more than half of your retirement nest egg, and you're left with $400,000. Now, if you take that $400,000 at a cost of living expense of $60,000 per year, you're only going to have 6 years to live off of that with a pre-tax plan. Now, if you look at an after-tax plan, the same concept, $5,000 per year over 40 years, but it was already taxed upon deposit. And when you withdrew it, the government can't tax you again because it was already taxed. So you're taking that money at $1 million whole with no income tax. How long will it last you if $60,000 per year is the cost of living? It'll last you 16 years. That's why if you were to take advantage of both pre-tax and after-tax plan, you can take advantage of both. Now, if I were to ask you guys, what's better, pre-tax plan or after-tax plan? Obviously, the after-tax plan, because you can withdraw the money without being exposed to the highest tax bracket. Okay, but 16 years isn't long enough. How do we make it great? This is where chapter 6 comes in with annuities. Now, if we put it into a trust fund and we annuitize it every single year, we take that same $1 million, you can either invest it or you can insure it. Now, if you take the investment route and you invest it at an average 6%, you could gain some money, but you're going to expose it to the market. But the other route is if you insure it and guarantee at 6%, what does the math look like? The math is, what is 6% of $1 million? $60,000. So that year you yielded $1,060,000. And if you only withdrew $60,000 from that, what is the amount of money you have next year? $1 million. So by definition, if you're only really withdrawing the interest, the principal is never depleted. So this is what you call legacy planning. And according to the time value of money, you are building wealth and upon wealth by compounding interest. That's why it's working in your favor. This is what we call in Proverbs 13:22. A good man leaves an inheritance for his children's children, but the sinner's wealth is laid up for the righteous. And so if you take that $1 million and you gain 6%, and you only take 6%, which is 60,000, you'll always have that principal there, and you're giving that to your children, and you build generational wealth. I hope that's clear. I hope you found insight from this presentation. God bless, and stay safe. Thank you.